Welcome back to the Property Punch podcast, your go-to blend of bold property insights, straight talking strategy, and wealth building wisdom.
And hi, I'm Washington, your property mentor here at your Wealth Mentor, helping our clients to build wealth through property.
And I'm Thabo, learning the ropes, asking all the real questions, and making sure everything's broken down so that we all understand property investing.
Today's topic is a very special one. We are discussing on how to select a good growth property in a good growth area. A topic that separates the average investor from a wealthy one.
We're unpacking what capital growth really means, what drives it, and how to spot the next hotspot before everyone else does. Alright, let's start with the basics, Dad. What exactly is capital growth?
Like the way we have explained it in our previous episodes, capital growth simply is the increase in the value of your property over time. Let's take an example. You buy a property for $500,000 and after 5 years, that property is now worth $700,000. So $200,000 is your capital growth. Capital growth is the wealth building engine of real estate.
So it's the reason why people say time spent in the market beats time in the market.
Look, the longer you hold on to your property, then the more it compounds in value. As we have always said in the past, property is a long-term game. However, not all properties grow the same way. Some areas stagnate, whilst others explode in value. The trick is knowing what makes your property grow.
And that's what we're trying to drive into today. What to look for, what to avoid, and how to make smart choices. So Dad, what are the main drivers of capital growth?
My main drivers of capital growth, I call them the GROW, G-R-O-W. We want to jump straight into it. So the G is for government and infrastructure. New infrastructure. This is like highways, train stations, hospitals, and schools. This creates accessibility and jobs. For example, think of Western Sydney before the airport announcement. Another one in Victoria is the Big Build, which is a program that is designed to support population growth over time. In particular, the Merrifield City that is happening in the Melbourne North. Up in Queensland, there's the Queensland Olympic Games, which is attracting massive Queensland Olympic Games related spending. So that's the G. And then the R is the rising demand and population growth. Property is more like simple economics 101, the law of demand and supply. If more people want to live in an area than there are houses available, then that increases prices. So watch for areas with strong population growth, job opportunities, and lifestyle appeal. At the moment, Australia has a high and growing demand for skilled migrants, particularly in healthcare, construction, and engineering. The skilled migration program is designed to boost the economy by filling the shortages. With the 2025-2026 permanent migration poised to around 186,000 places. That is more than half of the population of Canberra. And then the O, the owner-occupier appeal.
How does owner-occupier appeal affect capital growth?
So the more desirable a suburb is to live in, the more stable your capital growth is. Good schools, parks, public transport, and entertainment. These attract long-term demand. So coming back to your question, in an area where there are more owner-occupiers, you can just have the feel by probably the way people look after their houses, cutting grass, sweeping the yards, making sure that, the maintenance is to the T. You can just have a feel that an area has got, a bigger appeal for owner-occupier. If I'm an investor and I am looking at buying in an area and there is a bigger percentage of owner-occupiers compared to renters. In my example, 70% of owner-occupiers. I would buy in an area like that due to the fact that, as I said earlier on, it's a more desirable area because generally owner-occupiers tend to look after their houses in a nicer way. They provide tender loving care to their homes. But most importantly, a smaller percentage of homes that are available for renters would mean that it's less competition for me as an investor for those homes that are available for rent. So let's look at the next one, which is now the W. And our W is wages and employment. So capital growth thrives in areas where incomes are high. High employment means people can pay more for housing.
So when we look at growth potential, it's not just about price.
Not at all. Also look for areas with diversified employment activity. For example, in an area where there could be employment in retail, healthcare, social services, which is more diversified, would be a better area to invest in compared to an area where it's only one type of economic activity. For example, a big mining town. The reason being that in a big mining town, there is, let's say, a mining bust or low demand in the mining activity, then you can imagine it can easily be a ghost town because all of a sudden, people don't have jobs. And then when people don't have jobs, they can afford to live in there, and it can actually be disastrous. And we saw that a while ago, about 20 years ago, in some parts of Western Australia. Just to reiterate, my 4 drivers of capital growth are the G, growth and infrastructure. The R is for rising demand and population. O is for owner-occupier appeal. And the W is for wages and employment. Data is just a starting point. The real insights come from what's driving or what's behind that data.
So now that you've told us the 4 main drivers of capital growth, we should get a bit more tactical. How does someone actually find a good suburb for capital growth?
Good question. Here is my 5-step checklist. Number 1, look at the median price movement. Check if the property prices are trending upwards in a period of, let's say, 3 to 5 years, not just a 1-year period. I'll also look at the rental demand. Low vacancy rate is equal to high rental demand. The national average of vacancy rate is about 3%. So I'll be looking at the areas with anything under 2% in vacancy rate. The infrastructure pipeline. Look at the planned and approved projects, not just the current ones. And more importantly, population growth and migration. So are people really moving in an area or away from it? And finally, the demographic shift. If young families and professionals are moving in an area, that is a good sign.
So it's almost a little bit like detective work. You're connecting all the clues.
You are looking for alignment. Growth doesn't just happen by accident. It's usually the result of 2 to 3 strong fundamentals that are working together.
So that's a lot of theory talk, but how about the numbers? A lot of people get caught up in the story, this suburb is booming, but forget to check if the numbers stack up.
Correct. Numbers are always important. Like what we always say here at your Wealth Mentor, it's all about numbers. So what do we look for? We look for the rental yield. So rental yield is the annual rent divided by the property value multiplied by 100. So if we need to calculate the rental yield, let's say we buy a property for $500,000 and we're receiving $500 a week, then the rental yield is equal to 500 times 52 weeks divided by 500,000. And that's a 5.2% rental yield. So anything with a minimum of 4% rental yield is acceptable. And then the vacancy rate. Vacancy rate really is the number of vacancy properties divided by the properties that are for rental in an area. So again, you want to make sure that you're looking at getting into a property with a very low vacancy rate. And here we're talking about probably a minimum of about 2% as a maximum acceptable vacancy rate. And then the annual growth rate, as well as owner-occupier percentage and days in the market. Look, if we want to average out anything in the major capital cities, around 6 to 7% on average, let's say over more than 10 years is acceptable. And probably in regional areas, anything around 5 to 6% is also acceptable as well. This growth could be slightly lower if we're buying apartments, because apartments tend to grow slightly lower than houses. And then owner-occupier percentage, we touched it earlier on, where you're looking at in a city or in a suburb, on the total number of houses, how many are owner-occupiers compared to how many are renters. So you want to make sure that you're buying in an area where there are more owner-occupiers than there are renters. Simply, like what we mentioned earlier on, you want to make sure that one, there's owner-occupier appeal, and most importantly, there's also less competition when your property comes onto the market as well. And then days on the market. Days on the market, one day you might want to sell your property. So the less the days on the market, it means that if you put it on the market, then buyers are gonna snap it. So there's a higher demand in that area compared to an area where the days on the market are longer. So if a suburb has got strong rental yields, low vacancy, and higher owner-occupier appeal, you are looking at consistent capital growth. And the underlying word here is consistent, because that's what you're looking for.
So capital growth is basically a mix of math and mindset.
That's correct. So you use data to shortlist, but you use wisdom to select. The numbers tell the story, and strategy decides the ending.
That's all well and good, but what are some of the biggest mistakes you've seen either clients or other property investors make when chasing capital growth?
Oh, there are plenty out there. But today I'll just touch on the main three. The first one is buying on emotion. That's the most common one. People are saying, I would live there. This is not a strategy. Buy based on data, not decor. Because at the end of the day, you're not going to be living in the property. I'll give an example. Clients trying to say, we want to buy an investment property on a big piece of land. So when you're doing that, you are not going to be living on that piece of land or that property. After all, from our experience, the bigger the piece of land, then the more money you're going to spend on maintenance. Because tenants just don't like, looking after, cutting grass and looking after the backyard and all that. So that's one example of buying with emotion. Then, following the crowd. By the time that is in the media, it's already too late. Most investors want to buy in an area where they've had at a barbecue that this area's got good growth. But sometimes it's too late. People have already made money, and the clever ones might have already sold if that's their strategy to be selling. And then the third one, ignoring fundamentals. For example, a cheap property price in a weak location isn't a bargain. It's a warning sign.
So you're telling us all to stay disciplined and follow the fundamentals.
That's correct. If you can keep emotions out and strategy in, you'll win the long-term game. So here is your capital growth action framework to follow before your next purchase. Number 1, research 3 to 5 suburbs across different states. Number 2, compare the median prices, the yields, and the vacancy rate. Number 3, visit or virtually tour the area. See what's actually happening on the ground. Number 4, check the infrastructure and the population focus. And 5, seek advice from professionals. Speak to a good property mentor, buyer's agent, or local experts.
So it's not all luck, it's a process.
That's correct. Growth happens when strategy meets patience.
Alright, so let's wrap it up in a few key takeaways.
Capital growth comes from fundamentals, not hype. Do your research, follow the data, and invest where demand is heading, not where it has been. Focus on areas with infrastructure, income growth, and lifestyle demand.
In your action step this week, pick one suburb you've had your eyes on recently and research it properly. Look at growth trends, infrastructure, and vacancy rates.
And if you want help with analyzing your options, book a complimentary strategy call at yourwealthmentor.com.au.
That's your pull for this week. And until next time,
Sip smart, invest better.